You know, every single day, trillions of dollars are flying around the globe, and it's all based on one thing: trust. But trust in what exactly? Well, it all comes down to a shared rulebook, a universal language. We're talking about basic accounting principles. These are the absolute, non-negotiable rules of the financial game for everyone, from the little bakery on the corner to the biggest tech giant on the planet. So let's just start with a really big question here. What's the one thing that stops any company's finances from just becoming a total chaotic mess? Seriously, how can an investor in, say, Tokyo look at a company based in Toronto and have any confidence in what they're seeing? The answer is that shared set of rules. Without them, it would be the Wild West, total chaos. So here's our game plan for this explainer. We're literally going to build our understanding from the ground up. We'll start with the very foundation, the universal language of it all. Then we'll define the playing field. After that, we'll see how we keep score over time, cover the really crucial rules of fair play, and then finally, we'll tie it all together and see why these rules are the absolute bedrock of our modern economy. All right, Section 1, the foundation of finance. Let's get right into the universal language that makes this whole thing possible. Okay, Section 2, defining the playing field. Look, to understand any game, you really need to know two basic things, right? Who's actually playing, and how in the world do we keep score? First up is the business entity concept. And let me tell you, this one is absolutely crucial. It basically means the business is its own person. Financially speaking, it is completely 100% separate from the people who own it or run it. The business's money is not their personal money. End of story. And this little analogy just nails it. The baker is one person, and the bakery is a totally separate thing. The bakery's assets, its flour, its ovens, its cash register, all of that belongs to the business, not the baker's home kitchen. This separation is rule number 1. It's the starting point for everything. Okay, next up, how do we keep score? Well, the money measurement concept tells us we have to use a common yardstick for everything, and that yardstick is money, plain and simple. If you can't put a dollar sign or a yen or a euro on it, it doesn't get officially recorded in the books. This is what makes sure everything is comparable. Right, so a company might have the most brilliant employees and a killer reputation, but you can't just write great reputation on a balance sheet. It doesn't work that way. What you do record is the monetary value of the things you can measure, like those 3 delivery trucks. This keeps the score objective. So, moving on to Section 3. We know who's playing and we know how to measure value. But here's the thing. A business operates for years, maybe decades. So how do we track how it's doing without waiting until the very end? And this is where the accounting period concept comes to the rescue. Obviously, we can't wait 50 years until a business finally closes its doors to see if it made a profit. So what do? We chop up its life into these artificial chunks: a month, a quarter, a year. Think of it just like innings in baseball or quarters in football. It lets us check the score at regular intervals. Okay, now, this next one. This is probably one of the most important concepts in all of finance, so lean in. It's the accrual concept. This principle tells you when to record a transaction. And the absolute key, is that it has almost nothing to do with when cash actually changes hands. This slide just lays out the difference perfectly. With accrual accounting, which is the standard, you record revenue the moment you've earned it, like the second you finish a big consulting project, not weeks later when the client's check actually shows up. Same with expenses. You record an expense the moment you incur it, not when you pay the bill. It just gives you a way more accurate picture of how the business is actually doing. Here is a fantastic way to think about it. A farmer does all the hard work and creates value when the crops are growing and being harvested. That value is earned during that season. So the farmer records that value then, even if they don't actually sell the crops and get the cash until the next quarter. It's a true measure of the work they did in that period. Makes sense, right? All right, on to Section 4, the rules of fair play. So we've got our players, we've got our scoring system, we've got our timing. But for the whole game to be trustworthy, for people to believe the final score, you need rules for fair play. These are the principles that ensure the numbers are reliable and aren't telling a sneaky, misleading story. The first rule of fair play is what's called the going concern concept. And honestly, you can just think of it as a rule of optimism.
By default, we assume a business is in it for the long haul. We assume it isn't going to shut down tomorrow, and that assumption changes how we value everything. That is the perfect way to see it. In accounting, we treat a business like it's running a marathon, not a 100-meter dash. We assume it's going to finish the race. This assumption is so fundamental because if we thought it was about to go bust, we'd have to value all its assets at these rock-bottom fire sale prices. Next up, the consistency concept. This one is so simple, but it is so powerful. A company has to pick its accounting methods and then stick with them year after year. Why? Because if you keep changing the measuring stick, you can't meaningfully compare this year's results to last year's.
Let's look at an example to see why this is so important. A company reports these profits in year 1. Okay, on the surface, looks pretty straightforward. And then in year 2, they report this. Hey, it looks like they grew. Awesome, right? But what if they just changed the rules for how they counted their inventory or recognized their revenue? The numbers look better, but the business itself might not be. That's exactly why consistency is so crucial for building trust. And finally, for our fair play rules, we have the prudence concept. You'll also hear this called conservatism, and this is the ultimate play it safe rule. When you're faced with uncertainty, you should always choose the option that shows a less rosy picture, the one that's least likely to overstate how well you're doing. This classic saying just sums it up perfectly. You should anticipate and record potential losses as soon as you see them coming. Those are your broken eggs. But you only get to record gains when they're absolutely, positively certain. In other words, after the chickens have hatched. Okay, Section 5, why these rules matter. We've defined the players, the score, the timing, and the rules of fair play. So let's pull the lens all the way back. Why do we go to all this trouble? What's the point of this entire financial language? Well, at the end of the day, it all comes down to this. These rules create a system of trust that works for everybody. They create trust for investors, so they have the confidence to put their money into a company. They allow for fair comparison between different businesses. They provide reliability for the business owners themselves, and they ensure clarity for everyone who depends on that business, from employees